Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Corso, President and Chief Investment Officer of Advisors Asset Management. We have Alexandra Browne, Senior Managing Director and Chief Development Officer of Lido Advisors, as well as Erick Rawlings, Managing Director and Head of Manager Research at Fiduciary Trust International. We're here to discuss why select alternative assets and portfolio construction can lead to better portfolio results for income diversification and alpha generation. It is great to have everyone with us. Welcome to Trade Talks. And Cliff, let's kick it off with some macro thoughts first, because of course in an environment where it's higher rates for longer and inflationary, it really does change the investing landscape.
Yeah, I think that's exactly right, Jill. I think it's maybe not the higher for longer theme, maybe it's just higher, period.
Right.
Because if you look back before the markets were manipulated over the last 15 years, right, with the Fed pushing rates to zero ultimately, the government buying bonds, it's been a manipulated market, obviously coming off the crisis. So now when you look at it, I think what we're really in here is a return to normalization of the market. Okay, inflation's the big dog. We had some numbers today, 3-4 for the core. Everyone's rejoicing because it came down a hair. I think the bigger picture there is, and it's our view anyway, that inflation will probably be a little bit sticky, 3% maybe, not 70s. That's okay. I mean, most of my 30, 40-year career, inflation's been 3-ish%. That's been okay as long as it's stable. So again, I think it's a process of normalization, but it's going to take some time, I think, to work its way through for sure.
And Elliot, that's a great point that Cliff makes, because from a historical perspective where we see rates now, they are relatively normal. To Cliff's point, the past 10 to 15 years, we just got used to the type of model, the environment that we were in. So perhaps this is the new normal, and this is how markets traditionally function without everything just going in one straight direction for 15 years.
Absolutely. There is without question a recency bias, right? They are so focused on where we were. The question is, will one rate cut, will two rate cuts get us back to cost of goods pre-inflation? Do they expect things to come down in lockstep? And one would argue the answer is probably no.
Yeah, and I would agree with Ali, Eric, because the fact of the matter is, and we know in certain areas of the economy like insurance and housing, even just basic goods, a lot of things in the categories are up 20 to 25%. 50 bips is not going to change the calculus there. And I would also argue, if you do get the rate cuts that the market was expecting in the beginning of the year of 6 to 7 of them, we got a big problem with the economy, right?
Right, but I think part of it is, we talked about like the new normal in that period post GFC, and I'd almost say that wasn't the new normal. That was just the abnormal, and now we're kind of back to where we were, and out of that, the whole reliance on that stock bond correlation starts getting challenged, as we've seen over the recent time period, and so that's where, when you start thinking about these quote unquote alternatives, that's where they can make a portfolio more robust. Particularly like in a year like 2022, where you had meaningful losses across your stock and bond portfolios, you can bring in some of these diversifying asset classes to limit that.
Just to add to Eric's point, if you look back pre-global financial crisis at the correlations between a 60-40 portfolio, they weren't, I'm talking about the prices, they actually weren't balancing each other. They actually were often on rolling 3-year and 5-year periods going the wrong way in terms of protection around the portfolio. So I'm not saying, yields up, it's not a bad place to be. You got a real yield if I put income back in fixed income. But I think the message to think about here is maybe those correlations are a little less stable. And so you have to think about what you're going to do about that in portfolio construction. And I think, key principle in investing just at large, obviously, is diversification.
Right.
So, the 60-40 was a diversifier, but maybe a little less predictable, and that's, I think, where the alternatives come into play here.
Right, so Ali, if we think, I wouldn't say the 60-40 model is broken, but to Cliff's point, it is unpredictable. So what does alternative investing actually mean?
Yeah, the 60-40 model, I wouldn't say it's necessarily specifically broken, but has it evolved the way that we have evolved as a society? Look at 2022 for an example, right? Rates were at zero, right? Rates went up very large in a very big way, in a very fast way, and the market came down. Where was your diversification? If you were in stocks, bonds, and cash, you were down big time. And so that's where alternatives, I think, really, really come into play, because I think the word alternative really bends with, when you look at the type of alternatives, building in more control, more control around your outcome, right? We have no control over the Fed. We have no control over earnings, right? How can we build in more control through what we're trying to achieve through our portfolio? More stability, real estate and private equity and middle market lending and some of those pieces. Like, it's all about building in control and more defining our outcomes outside of asset classes that we have zero control over.
So Eric, is this only for the uber wealthy and pensions and endowments? Sometimes when you hear alternative investments, you think of, you need $100 million, $500 million to invest.
Yeah, the Yale or Swenson model. I mean, the short answer is no, but I think the level of thoughtfulness, whether you're doing a drawdown private equity style vehicle or an interval fund, needs to be the same. Yes, on those interval funds, quarterly liquidity is potentially available, but it really needs to be thought out as a strategic asset allocation to this asset class. And then to Allie's point, I think it's really important to have very clear ex-ante expectations for each of those asset classes. So kind of getting to that control of an outcome where, why are you allocating to hedge funds? Like, what is the expectation for that asset class? Like, for us, it's supposed to be a fixed income complement, something that's uncorrelated but that can give you an absolute return. Private equity is really more about capital appreciation. And so when you're picking your investments there, it's one, being really intentional about why you're doing them so that way you can stay in them, but then also trying to build in that diversification.
Eric, I'll comment on your Yale example, because I think that's a fantastic example of how we've shifted over the last 30 years. If Yale's very public with their knowledge, they're very well known for thinking outside the box. And if you look at how they were positioned in the early 90s, right, 80% of the portfolio was cash stocks and bonds, right? You got a lot of diversification through different market caps and through different international and small cap and so on and so forth. And if you look at how their portfolio has trended and what they're holding in their endowment now, 20-30% is in your typical stocks, bonds, and cash, which means the other 70% is doing different types of things. And so looking at that model over effectively a 30-year period is interesting to see where the trends are headed.
Yeah, I think to Allie's point, you see as the public markets actually are shrinking in equities. 8,000, 10 years plus ago, 8,000 companies, now 4,000 companies. And you mentioned private credit. Right. You mentioned private credit. They're filling the breach. That's a significant asset class unto itself. Yeah. 1.7 trillion.
Yeah, I mean, you think about like Microsoft when it IPO'd in the 80s, it was still a relatively young company. Today you have, Uber was very well established by the time it came public.
They're saying private, 10 to 15 years at this point, because there are alternative ways to access capital. Cliff, when you think about alternative investments, does that necessarily mean they're more risky?
Actually, no. I think although there's a misnomer maybe out there that alternatives means risk, it can be quite the opposite. And I'll just take private credit again. Right. So what is private credit? It's not public credit. Public credit being bonds, typically. So if you look at bonds versus private credit, which firms specialize in lending to companies that are private. If you look at public credit, it's senior to equity, but it's junior to the lender. And so the lender, the private lender, is senior in the capital structure to the bonds. And you'll see examples where the bonds are not that much and sometimes less cheap than the actual private credit due to the nature of it. So you have higher security and a higher return. Plus, bonds typically have a fixed rate component to them, most typically, duration. So it has volatility and sensitivity to interest rates, whereas a lot of the private credit market is floating rate. And so you remove that beta to the bond market itself or the duration of the bond market. So it's a really good diversifier within a credit space. It's an income generator, and it's an alpha producer, and not necessarily less risky.
And I'll comment on that because it's, how do you define risk, right? Because a lot of people, and this is where we, within the wealth management space, people define risk as volatility and seeing things go up and down, right? One of the bigger risks involved with alternatives is illiquidity, right? But if it's a 2, 3, our markets look at if things aren't liquid on a daily basis, it's got a high degree of risk and education that's involved around that. And so some people don't look at illiquidity as a risk, right? They've got a Roth IRA that they're going to leave to their child that they're never ever going to touch. So illiquidity is not a risk that they think in their mind as a risk. And so how do you define risk as a big answer to that alternative piece?
Right. Is the risk the ability to change your mind?
Yes.
And then what's the trade-off between that daily volatility? The benefit is you can change your mind on a day,
Right.
whereas a private equity, it's, well, you're going to change your mind in a decade.
I think both Eric and Ali have really good points because we think about risk bucket allocations when we're building portfolios. And there's a bucket for credit risk, there's a bucket for equity risk, a bucket for duration risk or interest rate risk. Where is the bucket for liquidity risk, right? If we want to call it risk. Because if you're thinking about a portfolio construction, as you guys are just pointing out, why not harvest the illiquidity premia that are offered in some of these assets, right? And so again, I think you guys make a really good point that it's about portfolio construction and the outcome that you're trying to produce.
So Eric, if portfolio construction is getting more complex and so forth, how important is manager selection?
Right, so that's where, again, you have clear ex-ante expectations of why you're doing it. You have a clear understanding of the attendant risks with that, illiquidity or however we want to bucket it. And then the other part of it is your execution risk. And as you move into these private markets, the spread becomes that much larger in terms of your outcome. So you could make the right choice to do it, but then stub your toe on execution. And as an example, within private equity or venture markets, the spread between the top and the bottom manager can be 50 to 80%.
Right.
So one, you're making an above market return, and the other one, you're actually losing money. So it's a very widespread in terms of ability to execute.
Yeah. Cliff, I also think it's interesting when you think of private equity, how you can get into different verticals such as sports, as you have noted here, that might not be available for direct public investment yet.
Yeah, absolutely. I mean, there is that area in particular, a strong emerging trend in sports as an investment. And if you viewers picked up Barron's this weekend, it's the cover article in Barron's. There's a lot of activity here. And sports is also a very wide category. But part of what's occurring in the sports world is a lot of the major leagues are allowing minority investments from asset managers and PE firms. And why are they doing that? It's, sports are really a good entree or hooked into what's going on in media and streaming and eyeballs. And particularly not only in the big leagues, but in the emerging leagues. That's really where a lot of the opportunity lies. And that could be in women's sports in particular. I think we all just witnessed that. Soccer, basketball, it's globalizing. I think one or two of our major league teams are over in Europe playing, right? Soccer is here.
We got the big
Cricket was
the big
here
cricket
last week.
was here.
Yeah, how about that? Yeah.
But I mean, even if you think about sports, you have, I've been reading that even some private equity firms are looking to invest when it comes to name, image, and likeness, and being able to provide the capital for schools to do that. I mean, that's how niche it gets. I mean, I've met with companies where they're doing investments on musicians' royalties and so forth, which I think, we were talking about this off camera, Ali, but the way you're able to slice all these different things, and it allows it to become more accessible and more diversified for investors.
Yeah, no, absolutely. And that's where I think the alternative world has been noted to be a very unapproachable space. Right, you have to have an ultra high net worth. You have to have access. You have to have a friend. I mean, it's what's talked about at the country clubs, right? This fear of missing out, and that's where I think value comes in with hiring a manager who has experience, has the access, and it's all about control, right? Like we talk about the real estate sector for an example, right? It's really funny understanding how real estate investors, what their liquid portfolios look like. They're either in all real estate or they're very heavy cash. And there's a reason behind that, right? Real estate investors love the control that they have around real estate. Yeah, it can go up and down. Yeah, it's a liquid, but they choose when to sell it. They can rent it. They have that control mechanism. So that's a piece that I think the liquid markets is missing. And so being able to slice and dice, hey, I want to take some risk with the private equity piece. Maybe I'm going to put up what I'm willing to lose, right? But that doesn't mean it doesn't necessarily have a place within an overall portfolio.
Right. Do you think there's, Eric, any risk for this to become overcrowded, or one area of this to become overcrowded in any way?
Yeah, I mean, I think that's sort of the history of markets, right, of taking a kernel of truth and extrapolating it into oblivion. So I think that is absolutely a risk, and again, that to me is, sort of the cautionary tale of really, again, having the clear ex-ante expectations, understanding the attendant risks, and then making sure that you're partnering with somebody that can execute it properly for you.
But I think, Cliff, I mean, that's just financial advisory in general. I mean, you could do the same thing. What if you piled in GameStop and mortgaged your house on it? I mean, the risks, you are making that risk by putting your
For the moment, we look pretty good, but
right. But I just think it's human nature, whether it's your ultra high net worth and in private investments, or you just came out of school and you're trading on your app on your phone. You have to understand these risks.
Yeah, I think often about a phrase I heard: success is the worst teacher. Success begets success, and I remember the era back before the global financial crisis. The theme was that the cycle has been eliminated. Monetary and fiscal policy have eliminated the cycle. Well, what a way to create a massive downturn cycle, because you're all in then, there's no risk, right? So I think it's key. Yeah, that definitely would be areas where they'll get a little bit too heated up. And I think you've raised a very good point, which is then you have to know your partners, because as Buffett says, when the tide goes out, you want to make sure you have your swim trunks on. So I think that's critical in choosing the right.
I don't want to seem cynical here, but I feel like there's a lot of short-termism in the market as well, right? We saw what happened with exotic products that were introduced for these types of investments prior to the financial crisis. Wall Street, you're always looking for a new product to introduce and be first to go to the market. I mean, do you think the controls are in place that there will be some more guardrails around this?
Well, a lot of the deregulation that occurred is really, aimed at the banks, and obviously what happened in 08 with structured, vehicles and so on and so forth. So I think, there have been some lessons learned, but I think it's just in human nature that, will things potentially overheat here or there? Sure, but it's a little bit more decentralized, I would argue, because you had this big systemic risk in 08. I got a guarantee from you, but you bought the stuff from me, and then you go bankrupt, and you go bankrupt, and you go bankrupt. It was a highly leveraged system. And I think one of the reasons, again, why private credit and private markets are growing is it decentralizes it somewhat. So I think that's are we all the way there? No, probably not. But I think it's that's a outgrowth of what happened in the 08 financial crisis for sure.
Yeah, I mean, it's hard to imagine, Ali, that we're about 15 years away from that already. I mean, so much just changed from a structural perspective.
Yep, nope, so much has changed. Allocations have changed. You look at where we've gone, obviously, who would have thought that with the rates falling, the infusion we've seen would last as long as it did? And so that's where we're getting this recency bias of, okay, well, I'm not going to sell my house because I have a 2% mortgage and I'm here forever, right? And so it's all about how much and where, right? Everything is appropriate in a certain amount as long as you understand the risks that are associated with it, right? And so that's very big, in addition to building in control and understanding what you're doing. And so within an alternative space, like, we love the options space. Options don't have to be this super risky, scary space like what we see in the media about GameStop. But how do we use options? Can be used as a shield to protect, right? Or a sword. You've got a large NVIDIA position in your portfolio. You want to buy insurance. You buy an option, right? And so, but how do you use options to your benefit? How do you use them to give you exposure to asset classes, especially as we're sitting at these new all-time highs, to build in control? One would argue that's a liquid alternative way to invest in a public market that has historically seen some of the best returns.
And you've seen a lot of growth in the wealth channel in particular, in what's called the structured products or structured notes. They do a lot of bundling together what Ali's talking about here, which is you can get a percentage of the upside of the equity market, give up a little bit of that because you're buying the downside protection. It's insurance.
Right, well, of course, I know your best option traders too, they go in thinking, how much can I lose? They're thinking about risk first before they're thinking about gain. And to me, that seems to, to be, that's a manager I would want to work with. Erick, last word here.
Well, no, I was just going to say, I mean, we're even seeing that bleed into the ETF space now as well. And sort of that, again, that moving down into accessibility, but again, it's more of, it might be accessible, but then is it appropriate? And so really to have people think about, why am I doing this? And then am I partnering with the right person to execute
and
on
that's why we have you guys here to answer those questions. All right, everyone, appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.